Thanks for joining us today for Berman's Call. We are here to take your questions on both stocks and ETFs. Here's how to reach us. 1-855-326-6266. You can email your questions as well. Berman's Call at bnnbloomberg.ca. Larry, good to see you.
Good to see you as well.
We have India now telling its citizens they have to start preserving fuel. We have Donald Trump saying maybe they'll get rid of the gas tax, federal gas tax for a while. Are there concerns now, you think, about energy and the hit on earnings later in the year because it's been going on for so long?
So, yes. Again, when you look at the markets at all-time highs, they're looking right through it. They just see the great earnings period we've gone through, tremendous for technology, and at this moment can't see anything else.
They're discounting then that what is a crisis.
So crisis, yeah, we have to define. Obviously, the part of the population that's paycheck to paycheck, all this makes it way worse. The top half are probably okay, and it doesn't really matter how long it lasts. And unfortunately, that's the reality of the world. The top half carry the economy from an aggregate demand perspective. And the markets are in aggregate, right? It's not about a single cohort or a group of cohorts that may feel some economic stress.
Does it mean more volatility in the markets as we go along?
It should at some point, because at some point it will matter. The thing is, you or I, nor anyone else can forecast it with precision. So, do you build your portfolio around event risk like this that's fun to talk about or interesting from a TV perspective? Or do you build your portfolio to make sure that no matter what happens in the unforeseen, that you have a good long-term experience? And that's really where most people should be and not really worried about the day-to-day noise.
So energy, we've already seen get more expensive. Then anything associated with transportation, your groceries, anything else that goes across country will get more expensive. What's next?
Well, do wages track, right? So if this happens long enough, people then start to say, you got to pay me more, right? So it's inflation expectations. Got an interesting chart on this in the educational section of the show. We'll dive into it a bit more.
Has the U.S. suspended the gas tax in the past?
I believe they have. We've certainly seen events, with Strategic Petroleum Reserve releases, anything to increase supply. Lowering price would help. It's a form of increasing supply. They never really rebuilt the Strategic Petroleum Reserve, so that's less of a tool, but they could still use, some combination. Again, that's temporary, gets you through a hurdle. Do they really want ultimately regime change in Iran? Based on what Bibi Netanyahu said on 60 Minutes, that's the game plan. Boots on the ground are going to be needed. They're not going to be able to bomb themselves into regime change. So, like I said from the beginning, this is going to get way worse before it gets better. Right now, markets don't care what Larry thinks.
And or this is something I'm going to touch on a little bit later, but the fact that if they end up suspending the gas tax, that's revenue the U.S. could use.
Well, sure. So it's just a temporary shift. The U.S. government has got the biggest pocketbook in the world. We've seen this over and over and over again. And that's what the safety net is all about. That government should be doing things like this in times of crisis, but not all the time. And they end up doing it all the time. And that's the problem with it, because when times are good, they're supposed to pay down the debt.
Yeah.
And when times are bad, they have debt to use to bolster the economy. Right now, they don't have a lot. The debt levels are astronomical.
Let's take a quick break. We'll get to your phone calls and your emails for Larry Berman when we come back. Here again is the phone number as well as the email address if you'd like to email your questions in. Larry will take your questions on ETFs and large cap stocks. Back in a moment. Welcome back to Berman's Call. We are here with Larry Berman. We'll get to an email first from Max. BUG is pulled back from record high of $37 to $30 and now is rising. Is it a good buy at the price? It has several top popular cybersecurity holdings. This is a cybersecurity asset here. Do you like BUG? Have you invested in this before?
I've not used this ETF. CYBR is the one I've used in the past, talked about it on the show many times. You know, a sector like this goes in and out of favor. You get a couple bad earnings reports, it sells off. Cybersecurity is going to be such an essential part of the future. And so this recent sell-off, great buying opportunity. Obviously, it's starting to recover. I would definitely be a dip buyer in cybersecurity forever into the future until we're at a point in time where cybersecurity doesn't matter, which I think is never. And
cybersecurity, is that business model at risk from AI?
So I don't think so, because I don't think every business out there is going to not buy someone else's software solution and try to create their own, right? I don't think that that's a thing. There's some talk about that with other aspects of software. I don't think at scale that will happen. Certainly there'll be anomalies, but I don't think it's that disruptive. What quantum is going to do in terms of the speed, in terms of hacking and the ability to break into systems, that is another big challenge for the cybersecurity space. So it's one of the most important factors as we digitize the world, and there's just going to be need for it across all businesses.
Let's get to another email. This one from Steve. Hi, Larry. I'm intrigued by ZRR for inflation hedging protection, but I'm concerned about downside risk on total return. Over 3 to 5 years, do you think the higher probability impact will stem from falling or actual inflation or rising real yields? Am I correct in assuming the latter risk is dominant? Okay, so this is the bond, BMO's bond index. What would you say is the threat?
Yeah, so real returns. So when you buy a real return bond, government gives you a very low coupon, and it's topped up by what the actual inflation rate is. So if the expected inflation rate currently priced into the market is low relative to what actually happens, you outperform in a real return bond. But the opposite happens if a lot of inflation expectation is priced into the current price and inflation is lower, you get a smaller coupon. Works against you. So you've got to be an expert in terms of forecasting inflation and where it's going to go to use these tools. And I've said these many times before. These are for experts and people who understand and have some edge in forecasting future inflation rates as to whether it should be part of an average portfolio. And I would recommend the average investor don't use these. Go to floating rate notes instead.
Let's go to Bob on the line. He's got a question. Bob's in Toronto. Bob, go ahead.
Hi, thank you very much. Larry, thank you for taking my call. I have a question with regard to these sort of enhanced yields ETFs. I'm 70 and looking to, basically get a bigger proportion or make a bigger proportion into income-producing assets. And I'm looking at some of these, like ZPH, which is the BMO hedge or put right hedge, and like the Harvest Healthcare. And I'm just wondering, like, what is the safety of principle like for these type of things over time? Like, I expect to put this away. If I buy this, put it away for 10 years. Okay. Thank you.
Can you tell us a little about the BMO U.S. put right hedge?
Yeah, so it's writing puts on U.S. stocks with the idea of owning them at lower prices to generate extra yield. This was one of the original ETFs that I was involved with BMO in creating. And I've moved off of recommending this one and on to ZPay, which is another ETF I was involved with BMO in helping to develop. ZPay is one where half the securities have puts written to acquire at lower prices. The other half is covered call. So it's a yield enhancement strategy. It gives you exposure to the market. On average, about 60% of the risk level in terms of the volatility in your portfolio, and you have about 3 times the yield of the S&P 500. So I like them for yield seekers, and I like them for people who want to take a little bit less risk and still want exposure to U.S. equities. So I would prefer ZPay and the principal safe. But like with any investment, if markets have a really bad period, these are going to go down. It's not full protection. It's less volatility and slightly less downside capture if the markets go into a bad bear market.
And he was talking about for a longer term hold, you're fine with that.
I am, but here's how you use these things. So if you're a coupon clipper, you want that current income, and you're in this, but then the markets are off 30%, right? That's when you get out of these, even though they're down, they might be down 25, and then you get into your long only exposure so that when the markets recover, and they will, go up a lot more, because these will not go up from a low base. They're good if the markets are stable, flat, rising slowly, falling slowly. But if they fall very quickly, you don't get a lot of protection. And when they recover, you don't capture as much upside.
Let's go to the next caller then. Ghulam is on the line in Toronto. Ghulam, go ahead.
Hi, good afternoon. Larry, you recommended ZUE and ZWB a while ago. I bought both of those, a small proportion, and I also wanted some exposure to U.S. banks. So I bought ZWK and ZWE. So I have those 4, and I was thinking of adding a little bit more to my portfolio. Which of the 2 of these 4 would you recommend I do that right now? Or would you suggest ZWPay, as I just heard you a few minutes ago?
Okay.
I'd appreciate your comment, please.
We have a number of choices in that lot.
So ZWE is European high dividend pairs. I like that right now more than any of the others mentioned.
Okay.
Just that there's a bit better relative value in Europe at the moment than I think anywhere else. So ZPay, U.S. equities, high end of the valuation. U.S. banks, high end of the valuation. So I'd prefer international over domestic at this point.
Let's move on to Andy on the line with a question. Andy, go ahead.
Hello to the both of you, and thank you very much for taking my call. Larry, I wanted to ask you about General Mills. I know General Mills and a number of its competitors, they continue to fall in value, the share price, but I'm determined to buy it at a price where I think that there is going to be some value here. Do you think this is a good buy here, or do you think you would hold off for a bit? I'm just interested to what you have to say about that. Thank you very much.
Thank you for the question. Do you see recovery for some of these food product companies in the current climate where people are moving away from processed foods?
I can guarantee they'll recover. I can't tell you when.
Okay.
So we're in a value trap at the moment. It's a common thing that investors like myself get into that look for things that are cheaper. Sometimes they can stay cheaper for longer periods of time than we would like. But if you're into buying low and selling high, General Mills falls into that category. And so we have it in our portfolio now. I'm not worried about it. I don't love that it keeps going down though. But I think there's good value here.
Why do you feel comfortable saying that it will rise when you have, again, sort of a societal move away from processed foods?
It's not just the processed foods. We need to eat, right? So you could say there's elements of society that are moving away from that. Mm-hmm. But at the end of the day, I think we still need to eat. People also do trade down a little bit when times are tough. So combination of those two, but definitely this is not a growth story, right? So we're not talking about growth investing. We're talking about value investing. We're talking about clipping a decent dividend. And so
General Mills fits that.
Yeah.
Okay. Let's go to an email from Sunny. I know you've been a proponent of private credit and private equity more recently. Do you still like those types of investment vehicles given the recent volatility in those investments?
So yes, I think for most, even with the volatility currently, but every stock has volatility, whether they're semiconductors now that are ripping higher but weren't a year and a half ago, or any other sector for that matter that goes through the ups and downs. So if you looked at PSP, and I don't know if we have that ETF that trades in New York to have a look at, but that's an ETF that covers the private equity sector. There's one that covers the private credit sector that we like very much, BIZD, BIZD. And that's another one that trades in New York. I like both of those to track the sector. And recently on my YouTube show, I talked about, private credit as it's oversold. A lot of these public BDCs are trading at 15 to 20% discounts because of the concerns. So again, as a value investor, this is what I like to look for. Some of the PE names are there for similar reasons. So I like them very much at this point. If they get cheaper, I like them even more. I can't tell you when exactly they're going to recover. But the sector makes sense to me, and we've been adding near recent lows.
Let's go to our next caller then. Patrick's on the line in Halifax. Patrick, go ahead.
Hi, I'd like to ask Larry about ZWU, the BMO Utilities ETF. I want to take some profits in the financial and tech ETFs that I have in my cash account, and I was interested in ZWU because they have the telecoms and also the pipelines, but I'm a little concerned about what happens when the effects of the higher oil costs, if they create a interest rate hike, how would that affect this particular ETF? Thank you.
Thanks for the question.
Yeah, so it's a good question. So there's a lot of CapEx in these names, whether it's one of the telecoms that has big infrastructure CapEx, parent of the station, BCE, falls into that category and is in that ETF. A lot of the traditional utilities fall into that category, pipelines as well. So it's much more interest rate sensitive. And if you are worried about rising rates, then there'd be some underperformance here. Then the question is, relative to banks and where you want to take that money from, what does that look like to you? And I'd be okay with that trade now, taking a little money out of ZWB to buy ZWU, if that's really the question you're asking about.
Let's get to our last caller here. Bruce is on the line in Victoria, BC. Bruce, go ahead.
Hi, Larry. A lot of the major companies are building huge data centers. These are all going to require lots of power. Is there any one or more ETFs that you would recommend to take advantage of this? Thanks very much.
Okay, so energy ETF, but that will be involved in build-out?
Yeah, and so I think there is one relatively new that plays this AI back engine energy lift. But I don't know it. I will find it. If I do find it, I will post it on X.
Okay.
And you can have a look there and within the next 24 hours. Battery technology in terms of the future is going to be huge. There's an ETF, very simple ticker, BATT.
Okay.
And
Whose ETF is it?
there's actually a couple of them that play, lithium battery technology. So, the whole space around that. But this battery one is more about the mining and the minerals and the battery building than it is about, clean energy or new energy or, small, medium size nuclear reactors, everything that's sort of powering this AI push right now.
So this is the amplified lithium and battery technology one. Okay. All right, we're going to take a quick break. We will come back with Larry's educational segment. That's next.
Larry Berman is one of Canada's top technical analysts. He's the co-founder and chief investment officer of Q Wealth Partners. To learn more, visit qwealth.com. Opinions expressed by Larry Berman are his own and do not necessarily reflect the opinions of BNN Bloomberg, its parent company, or affiliates.
Welcome back to Berman's Call. Larry Berman here with you to discuss right now the U.S. debt situation.
Oh, I've been talking about this for the better part of a decade, and I pound my fist on the table and I get angry when I see how governments spend our tax dollars. the worst thing for all this debt we have is inflation expectations rising. And as I was reading my Bloomberg terminal this morning, looking for interesting things that happened over the weekend, I came across an article and I thought, wow, this is interesting to talk about. So inflation expectations for 30-year yields. So they take the nominal bond and the real return bond. We talked about those earlier on the show. And they subtract the yield. And that tells you what the expectation is priced into the market for the 30-year Treasury. So if you look at that now, long-term yields haven't been higher in more than 2 decades in terms of inflation expectations. So one of the things that central banks always talked about, and one of Powell's favorite indicators was the 5-year, which is basically what are inflation expectations 5 years from now for the 5-year part of the curve, right? And when you start looking at all of those things, you end up seeing, a picture developing here. But really, this is anchored around what's happened in the last couple of years. So geopolitical risks are up. You've got trade shrinking in the world in the sense that, tariffs. So it's making everything more inflationary, inch by inch, hair by hair, but it's adding slowly. And you're starting to see this priced in to long-term inflation expectations. Why this is terrible is because the U.S. today has about $39 trillion of outstanding debt. And the cost of that debt today, so bring up a chart here. The yellow line here is the total weighted average coupon of U.S. Treasuries. It's around 3.38% right now. The white line is long-term bonds, and obviously interest rates have been falling, so that's been good long-term, but recently started to go up. The red line is Treasury bills. So this is where Fed policy is moving rates up and down. So the cost of money market debt goes up and down rapidly. The yellow line is Treasury notes, so shorter term coupon debt, and that's the blue line. And so the smooth line right now, 3.38, it is projected to keep rising. So one of the things they can do is issue debt in the cheaper area. Well, that's right now, today, bonds are cheaper than bills still. So this is why the president wants them to lower rates, but that will increase inflation expectations longer term. So there's a bit of a rock and a hard place here. And if this starts to trend higher, the cost of that debt as a percentage of GDP is going to just be unmanageable at some point. And so there's a lot of concern now. New Fed Treasury coming in. Scott Bessent wants to work with Treasury. One of their mandates is to lower the cost of investing. So it's going to be interesting in the next few quarters to see not the cost of investing, but the cost of the taxpayer in the U.S. That's one of the mandates. So it'll be interesting to see how cooperative the White House, the Treasury Secretary is, and the new Federal Reserve Chair in the next couple of quarters.
Okay, one to watch. We do have to leave it there. Larry, good to see you. And thank you for joining us today for Larry Joe Berman's call. We have the close coming up next. Stay tuned for that.